Passive Pockets is presented by Equity Trust. Multifamily syndication has been through major highs, major lows, and plenty of turbulence over the past few years. So where are we today, and what should passive investors be thinking about as they allocate new capital?
Welcome to Passive Pockets, the passive real estate investing show, brought to you by Equity Trust. I'm Jim Pfeiffer, joined by my co-host, Paul Shannon, and today we are thrilled to welcome back Andrew Cushman to the show. Andrew's an experienced multifamily operator who's been vocal and transparent about the challenges facing the industry. Today, we're getting his candid take on where the market stands, what's changing, and what passive investors need to watch out for. Let's get to it. Andrew, thanks for coming on the show. If we can start, can you tell us a little bit about your background, what you're doing today, and how you got here?
Yeah, I took the traditional path into real estate and got a chemical engineering degree. That was a placeholder. I knew that's not what I wanted to do, but I figured, hey, I'll always have a job and at least pay decent. So worked as an engineer for 7.5 years. My wife and I tried all kinds of little businesses, flipping cars and making popcorn and vending and all this stuff. And we're like, okay, this is just another brutal job that's worse than the ones we already have. In 2007, we discovered flipping houses. And back then in Southern California, there was lots of equity in houses. We did our first one in 2007, right before the great financial crisis. And when we sold it, we made as much as I made all year at my job. So I said, well, there's no clearer signal than that. So I walked in and quit my job right as the recession was starting. And it turned out to be really good timing because everyone was terrified of real estate. We had no competition. We'd buy stuff at 55 cents on the dollar, fix it up, sell it at 80 cents on the dollar, make a profit and keep going. But by 2009, 2010, we'd had really good years, but everyone else was starting to figure it out too. It was getting way more competitive. Margins were compressing. There was less equity to begin with. And then also, once again, it had turned into a brutal job because it was just my wife and I. We hadn't scaled it to, some of the 7-figure flipper guys you hear about now. It was just us. And so we said, all right, what is a better way to scale real estate? And then what's the next big thing? So we kind of saw the crash coming and the opportunity there. We're like, well, what happens after that? And we said, well, we just had a huge recession, which means we probably have a long expansion coming. A long expansion probably means job creation, household formation, rising incomes. And then couple that with the fact that everyone just got foreclosed on and can't buy a house for 5 to 7 or 10 years, or somebody they know just got foreclosed on and they're scared to buy a house for the next 5 to 7 years. That means we're going to have a ton of renters in an expanding economy, so apartments. And we had a coach for the single family flipping, and I called him. I was like, hey, do you know anyone we could learn apartments from? And he's like, actually, I do. And he connected us with a guy who had done 800 units. We hired him as a mentor. He held our hand to the first deal, which took about almost a year. And then as of today, we just closed another one about a couple of weeks ago. We're just under 3,000 units, and it's been a great business since. So,
congratulations on the success, Andrew. That's fantastic. And you've been in the space for a while, so I've been looking forward to kind of picking your brain a little bit. I followed you on social media for a while, and you've been pretty transparent about how you viewed the market over the last couple of years. Maybe back when you transitioned from single family into multifamily, it was a different landscape than it was, say, a couple of years ago, and now it is today. So where do you see the space today, specifically multifamily, versus when you were just getting going with it, with your business?
There's a lot going on today. And the first thing I would say is it's a challenge, but it's really imperative to focus on the long-term signal, not the current noise. Like, we're the Karate Kid of tariffs right now, like tax on, tax off. And it's like, what are we doing? And it's just like, okay, yes, that matters, but not so much if you're looking 5, 7, 10 years down the road. And so where I see multifamily right now is there's better opportunity than there was in 2022 and heading into 2023. Prices are down, depending on your market, maybe 20, 30%. The huge supply wave has crested and is starting to drop. Interest rates are higher than they were, but doesn't feel like it today, but they've kind of stabilized, right? The 10-year, which is the most important one for multifamily real estate, is in the 4s, which feels high to anyone who just got in the last 7 years, but that's actually historically pretty reasonable. When you put all this together, we already have a structural housing shortage. we have new supply is falling off a cliff and is projected to be well below average for the next several years. And what that does is that sets us up for increasing rent growth. So even if interest rates do stay where they are, even if they go up a little bit, and I would never underwrite to this, but I've seen myriad of forecasts projecting 5, 6, 7% rent growth as we get into 27 and 28, simply because of the supply demand imbalance. Also, if you look at the tariffs and just, everything that's going on, that makes it harder to build. That will exacerbate the situation. The one caveat to this is if we do get into a recession, that could delay the upcycle a little bit, and that's a whole separate topic, but something really important to watch. But long term, 5, 6, 7 years out, we are trying to acquire everything we can to position ourselves for that next coming upcycle. It's not as big of an opportunity as it was in 2010, 11, and 12, but it nonetheless is probably the best opportunity we've seen in a while.
So I would say you're bullish more than you're bearish, which I am actually as well, and haven't been in at least about 3 years. But I'm wondering just what you're experiencing when you're talking to LPs. What's the general sentiment? If you could gauge or poll the crowd, is it more difficult to raise capital? Seemingly now it might be a better time to invest, but is it now harder to raise capital while it could be a good time to buy?
Yeah, Paul, you're spot on. And that's what happens in every cycle. It's, everyone quotes Warren Buffett, right? When they say, the time to buy is when blood is in the streets, even if it's yours, and, be greedy when others are fearful and fearful when others are greedy. Everyone can quote it, but almost no one can do it. Right. It's so hard to actually, because we got this and this is a reason. And talking with LP, like I said, we just completed a raise a couple of weeks ago, and thankfully it went well. But a lot of the people I talk to, uncertainty, especially with all the tariffs, we could just collectively hear the sphincters tighten like a vacuum. And I talked to one of our investors is a gentleman who has solid 8 figures in cash and liquid assets. And when I talked to him, he was just like, "Oh, stock market's down right now. I'm going to pass. I'm going to hold off." And, and I'm just kind of thinking like, that's an interesting mentality to me because number one, stock market was down at the time we talked, maybe I think it was like 8%. But then if you zoom out, how much is the stock market up over the last 5 years? But just that little blip down just caused that a ton of anxiety. And this is a very wealthy guy. This isn't someone who's, he's got to make sure that this lasts for the next couple of years. It's not like, if he messes up, he's not going to be able to, buy medicine or pay the bills or anything like that. So the uncertainty, the drop in the stock market has definitely affected investor sentiment. And I think even more so what has negatively affected investor sentiment is rightfully so all of the deals that have gone bad and are still going bad in the last year. A lot of the syndicators, I don't think we had a real estate bubble. We had a syndicator bubble. A lot of people who just jumped in, quit their IT business, but knew a bunch of people who made 250 grand a year and pulled them all together, raised the money. There was a large cohort of people who just took a class. Hey, this is easy. Everyone's making money. They didn't know any better. And a lot of those deals are going bad because they got floating rate, high leverage loans. They didn't know how to operate properties. That's another big difference right now. For the last 10 years, basically all you had to do was take the advice of the YouTuber, take massive action, buy something, hold on to it for a couple of years, and you were a millionaire. That doesn't work anymore. You have to know how to operate these things. And a lot of people, newer syndicators in particular, just never got that training, didn't have the know-how. And so those deals are going bad. And then unfortunately, you had a lot that just saw an opportunity to grab a bunch of people's money and take as much of it for themselves as they could and not worry about what happens down the road. And all of that has put a black eye on the industry. I'll talk to some LPs and they're like, "Hey, yeah, our stuff with you is doing great, but I've made 12 investments and 8 of the other ones with other sponsors, those are all going bad. So I can't invest anymore. I have to wait and see what happens." Those things are very much making it much more difficult to raise money.
Over the past 5 years, we've had very turbulent times. We had big ups and then we had the big downs, like you were talking about, syndicator problems. And now we have uncertainty, right? That's the number one word everyone's talking about. But you're looking, forward 5 to 7 years so you can smooth out that uncertainty. But can you talk about how your strategy has evolved and will continue to evolve through kind of the ups, the downs, and now the uncertainty phase?
The fundamentals of our strategy haven't actually changed. And that's one of the reasons that we're still doing okay. And I will say that, I think we have 12 assets in our portfolio right now. Not all of them are exceeding pro forma, but none of them are distressed or in trouble. Every single one is cash flowing. And that's because of not trying to shift strategy too much just because of the short-term noise. So the fundamentals that stay the same are, number one, kind of what we talked about earlier, just the supply-demand imbalance. So we always buy in markets where there's income growth, population growth, job growth, all of those kind of things. Because if you have greater demand from people moving in than there is supply, rents are going to go up or at least stay stable, likely even in a recession. The key tenets are, we have always fixed our debt because, when you evaluate a deal, you want to say probabilistically, what are the things that could blow this up? And number one was like back in 2021, 22, we said, well, if debt shoots up, this deal could go bad real fast. We didn't think it would, but we're like, well, if it did, so we fixed. We didn't see this coming. We weren't smart enough to predict it. We're just like, well, that's a risk. Now, that's one of the fundamental strategies, is just always looking at risk and figure what can make your deal go bad. And if you can't significantly mitigate or eliminate that, you just don't do the deal. So our strategy has been and still is, we buy workforce housing, kind of like the B space right in the middle. And again, I'm not saying C is bad or A is bad. Like, we've just picked a strategy that's worked for us. So Class B, which tends to have the highest demand, is the most stable. We buy assets typically that cash flow from day one, so that we don't need any upside in order for it to at least break even. Those are the key fundamentals that haven't changed. In terms of strategy, what has changed, we are doing slightly smaller deals just because, like we said a minute ago, it is harder to raise capital. We really like value add long term, but we're not counting on, 5 years ago, you could buy a deal and say, hey, the rents are $400 below market, renovate those units, and then you had a very high likelihood you're going to get that $400. You can't do that now. Demand is softer. People can't afford higher rents. So we're being much more careful about projecting increases from value add. And then also, we're leaving more margin for expense increases like taxes, insurance, and wages. And then also, this is one of the short-term things that we have to account for is, okay, because of tariffs or whatever, our appliance is going to cost 25% more today than they did before. So the fundamentals haven't changed, but some of the short-term stuff of hey, the next 2 years, don't count on bumping rents right out of the gate. Renovations might cost a little more. Those are some of the things. I think it might have wandered a little bit. Hopefully I answered the question.
I think that's spot on. And shifting away a little bit from how you're looking at deals and how you're viewing the market, you touched on how LPs have been into some deals that maybe haven't turned out the way they would like to have seen them turn out. And that could be because of the market, the way the debt was structured. But in some cases, it's because it was from a person potentially that just didn't have the best interests of their LPs in mind. If you're an LP today, what do you think are the most important factors that you should consider when allocating capital? And how do you evaluate someone as an operator?
Other than the financial impact, any LP who got with a quote unquote bad operator, don't kick yourself too much for making that mistake, because at the end of the day, you are betting on the operator 95% and 5% on the deal. No matter how much as an LP you try to vet someone, you do all the research, things happen, people change. You never know what someone's going to do when they get under lots of financial stress, and then that creates marital stress, and then that creates health problems, right? Someone may do something or act in a way in that situation that they never would have previously. So nothing is perfect. Part of how I got in this business is I got scammed by a type of real estate syndicator almost 20 years ago. And I was like, okay, there's got to be a better way to do this. So you're never going to be perfect, but everybody talks about track record. Definitely look into track record. I would say if you're talking to somebody now who hasn't gotten into trouble, that they're probably a pretty good operator. An operator who's been through a couple of cycles. They didn't just start in the middle of the big bull market. And again, not to say don't ever invest with someone new. I wouldn't be here if people didn't invest with new syndicators, but that's just a good sign. If you're talking to them, asking them questions, what is the worst deal that you ever did? What happened? What did you learn from it? What did you change? And then one thing I see now is I see pitch decks with track record list put on there. Well, yeah, it's deals that were bought in 2018 and sold in 2021. That's cool. But my question is, the stuff you are holding today, if you sold it right now, what would the results be? Do you have any other deals that are under distress? Because that's another thing that I'm seeing happening is I know operators who have some apartment deals that are doing fine, but they invested in some other stuff or were involved in other deals that are going bad, and those deals took the whole company down. Unfortunately, I have a friend who that's happening right now. He is selling his office because he did some bad deals that ended up just taking the whole thing down. So yes, there's the deal. Yes, there's the operator, but you really want to get a global sense of what some of the outside risks might be. Again, when you're looking at the deal, upside's great, but don't focus on that. Ask every question you can think of what are the potential downsides, and then how has this sponsor mitigated them.
So you're talking about risk. And so, especially from the perspective of an LP, when you look at risk versus return and you're reviewing a pitch deck, every operator I think I've ever gotten a pitch from says, their pro forma, they're using conservative assumptions. So if everyone's making the same assumptions, right, they're conservative. Clearly, that isn't always the case. So how does an LP see through that and get to what the real pro forma should be or could be so that they can evaluate it?
I'm not a drinker, but I used to tell people that, man, if you want a good drinking game, just listen to real estate podcasts, and every time you hear the word conservative, just make sure you don't have to drive anywhere by the time you get to the end of it. So, and you're right, Jim, that is one of the challenges is like, okay, fine, what is conservative? Here's how we define conservative. I would recommend anyone use something similar. Internally, we use the word realistic. A conservative or realistic assumption is something that we feel like has at least an 80% chance of actually coming true. Nothing's going to be 100%. So I'll give you an example. Let's say you're looking at a pitch deck and the projected year 2 rent growth is 3%. Well, if I'm going to be investing as an LP, I'm going to do a little bit of research and say, okay, pick whatever market this is in. I'm going to go look up and say, all right, what are the forecasts? I'm going to look at for rent growth in the next few years, and then what has been the historical. Well, if this property is in a market where the average rent growth is 2.5%, and I'm seeing a pro forma of 3%, that seems possible, but not super likely. If I pull up forecasts that say, hey, this market is projected to accelerate in the next few years, and the forecast is 4, 5, maybe 6%, and the sponsor has it underwritten at 3%, that is a high probability / realistic / conservative underwriting. And I invest as and have invested and will continue to invest as an LP in other sponsors' deals. And that's what I would do. There's certain key assumptions that quote unquote make deals work. I mean, someone who knows Excel can financially engineer anything. And so you really need to look at those exit cap rates, those rent growth assumptions, and just go through and say, does that make sense with data that you source yourself? If the 20-year average is, and that's one of the things, well, what's the 20-year average, right? That smooths out all the ups and the downs. Well, if the 20-year average is 3% and the deal assumes 2.5%, your odds are good. But if it's 3% and the deal assumes 5%, which I still see sometimes, like someone assuming 5% rent growth every year, could it happen? Yes. Will it happen in some markets? Probably. Will I bet my money on it? No.
So you talked a lot about what LPs should be doing. I assume that doing the opposite of those things is probably not advised, right? So those are some of the common mistakes. But what are some of the other common mistakes that you see LPs making? Maybe it could be investors that have been around the block for a while and done a few deals, or just new investors when they're getting into the space. What do you see as kind of problematic when they start allocating capital?
One of the biggest ones that it's just human nature. Again, the scam I fell for 20-something years ago, this was actually the mistake I made. What I hear a lot of people talking about now in forums like with PassivePockets and some of the other groups that I'm involved in is kind of the herd mentality. Oh, well, I know 3 other people who are investing with this person and they say he's great. I'm just going to put my money in. It's just human nature to do that. Or just, well, okay, this person comes recommended by 3 people, so I'll ask 1 or 2 questions and just call it good. Again, that worked for a while. Unfortunately, now it's not. I think a lot of the mistakes I see is LPs focusing on the wrong things, comparing 3 pitch decks and just saying, well, this one has the highest IRR, so I'm going to invest in that. Well, if you've got 3 pitch decks, one's a 14 IRR, another one's a 16, and the third one's a 19, but the 19 only has a 10% chance of hitting it, and the 14 has an 80% chance of hitting it, which one's the better investment? I'm going with the 14. right? Because I'm probably actually going to get my return, and better yet, hopefully not lose my money. Because generally speaking, the higher the return, there's usually risk associated with trying to achieve that return. Those are the first two, one called the herd mentality, two, just picking the highest return on the projection. And then also, kind of Paul, like we said, doing the opposite of focusing on the wrong thing. There's a lot of questions as an LP that you should ask that kind of help build the picture, but are often mistaken for the core thing. Like I'll give one example is skin in the game. Hear that one a lot. Like, well, how much is the sponsor investing? That's a question that's typically promoted as like, you got to ask that, and you should. It is true. However, have you guys ever heard of an LP verifying that the sponsor actually made that investment? In 15 years, I have never had anyone actually come back and say, hey, could you show that you actually made the investment that you said you're going to? Because it's easy for a sponsor to be like, oh, yeah, we're going to put in $1 million. So number one, unfortunately, I've seen situations where sponsors say they're going to do one thing and then it doesn't actually happen. The second is if you've got a sponsor who you're kind of implying the only reason they're going to do a good job is because they put their money in, that's the wrong sponsor. You want someone who's going to do a better job because they care more about your money than theirs. If their only incentive is because they put in a chunk of money, that's the wrong person to be investing with. And then the third thing is once a deal goes bad and the sponsor's equity is gone too, if that was their motivating factor, they're done. They're out. They don't care. And most of the deals that are going bad right now, they're upside down. There is no equity, including the sponsor's equity, if they even put it in there. And so if that was their motivating factor, they're done. Is it a good thing if the sponsor's putting their own money in? Yes, because that hopefully means they're liquid and hopefully means that they believe in the deal. But it's a nuanced thing, but against looking at track record, talking to people, you want a sponsor who has more to lose by damaging their reputation than any chunk of dollars that they put into a deal. I mean, this applies to any business. If you plan on being in business for a long period of time, 5, 10, 15, 20, 25 years, your reputation, especially if you're raising capital, is worth far more than $500,000 or $1 million or whatever in one deal.
I think that's really, really well said because, I raised capital from friends and family once just to do a little single family projects in Columbus. And I remember I was looking at it, okay, somebody gave me 50 grand, somebody gave me 100, and looking at my bank account, making sure like if I really screw this up because I don't know what I'm doing, can I pay them back? Because I don't want to lose money, but I'd much rather have me lose money than them. And so I think finding that person, that's the challenge, right? Finding an operator who has that mentality is the challenge. But that was really well said. I want to move to 2 years ago, you were on the podcast. I don't know if you remember this, and you talked about debt. And you said the same thing you said today, that the increase in interest rates didn't really affect you because you were using fixed rate debt and you were realizing that rates were at all-time lows and would likely go up. And so we talked about this a little bit, but I want to dive a little bit deeper. Have your views changed on debt at all? It seems like you're still using fixed rate debt. Would you consider, if interest rates do go up or the way they are now, would you consider using some kind of adjustable rate debt thinking, well, maybe interest rates will go back down, or are you just fixed and forget it?
That's a really good question because, again, it's tough to do. The best time to use floating rate debt is when rates are high. When rates were almost zero, it made no sense to use floating rate debt because odds are they're going up, right? So now, if you're going to use floating rate debt, the time ironically would be now. However, we still don't. So one of the reasons to not use fixed rate debt for anyone who's not quite as familiar, like why would you just not do it all the time? You always refinance. Unlike with single family mortgages, where you can just kind of refinance over and over again every time the rates drop, which is one of the most beautiful, unique things about the United States of America. Like it does not work that way the rest of the world. Like that is a unique thing here, and it's a huge blessing to anyone who can get involved in it. But in the commercial world, if you fix your debt, you typically have either significant prepayment penalties, which can be 2-3+% of the loan balance, or what's called yield maintenance or defeasance. And without getting into the technicalities of that stuff, it's basically a giant prepayment penalty, meaning if you refinance early, you owe an extra huge chunk to the lender. One of the downsides of fixing is if you fix and then a year or two later on a 10-year loan, you're like, hey, rates dropped, I want to refinance. You could be looking at a really big prepayment penalty. That is one reason to not just automatically fix. If you're building something ground up, you're going to get a construction loan, which needs to be taken out with a permanent loan down the road. Floating rate, Variable rate, it's not the plague. It does have uses. The reason we stick with fixed is, number one, it matches our business model. Our business model is typically 5 to 7 to 10-year hold. We're not going to buy something that we need to get out of in 2 or 3 years. The market is too unstable, too unpredictable for us to say we're going to put ourselves on that kind of timeline. That's one of the reasons. The other reason that we, for now, always fix is it eliminates a huge risk of the deal. If you can get a deal or an acquisition to underwrite and perform today with today's rents and today's debt, and then you lock that in, just doing that eliminates most of the things that could take you out of the game. Could it limit your upside in the future? Yes, but upside is secondary. Your primary goal, either as a sponsor or as an LP, especially as an LP, is to make sure that downside is either, again, mitigated or eliminated as much as possible. And for us, we feel like fixing debt does that. Now, 6 months from now, if we find an awesome property in a great market that the owner got into trouble, they stopped running it, they went bankrupt, and it's 40% vacant because the owner just collapsed on it. In most cases, you can't get agency debt on it. You're probably looking at some kind of bridge loan or bank loan. Would we do that in that kind of situation where there's very clear reason for distress, there's very, very clear upside, and there's also a clear exit? Yes, we would. How we would mitigate the risk is we would go in with lower leverage, right? There's all these different levers you can move. So if I'm going to go floating rate today, knowing, hey, I'm probably going to need to get out of this loan in 2 or 3 years, instead of taking 70% LTV, I might go 55 or 60% LTV, knowing that, hey, if the market moves against me, I can still refinance out of this. We actually had that situation happen to us. We bought a property in 2021. It had a fire, so they were rebuilding a tenth of the property. So we couldn't get a fixed rate loan. We had to get a floating rate bridge. They offered us like 75%. We said, we're good. Let's just take 65. Shortly thereafter, interest rates went up. Things got much more difficult. We were still able to refinance into fixed rate Fannie Mae debt because we took the lower leverage. If we had taken the 75, we would have been in trouble, right? So there's different levers that can be pulled to mitigate different risks.
Yeah, I love your view on debt. I haven't used floating rate debt myself on any of my active investments. And there's a couple of things that kind of stuck with me. I think it's a tool. It certainly can be used, and there are prudent cases for it, of course, and risk tolerance matters. But there was a quote, and I don't remember who told me this quote, but something along the lines of bridge debt was not invented for the buyer to get the best deal. It was invented for the seller to get max proceeds. So for whatever reason, that just kind of triggered in my head, like, stay away from this dangerous tool here unless it's absolutely necessary. But I also remember Jim and I, we just interviewed James Ang, who's a lender down in Texas.
Oh, I know him. Yeah, he's a great guy.
Great guy. And he put it a really kind of a simplistic way of looking at it. If you're an LP, your returns are sort of capped. They're in a range. You're either going to get a 1.7 equity multiple if you get a really good deal and you hit a home run. Maybe it's a 2.3. The GP is going to make a huge amount of money if it's a home run, but the LP's returns are kind of in a fairly tight standard deviation. So why take the outsized risk with debt that's really aggressive that could just wipe you out completely? Why not just go down the fairway and, shoot for that 1.7, that 1.8, and if you get lucky, that's great. But don't be shooting for the stars and taking outsized risks.
Well, and then that allows the compounding effect to work for you. Let's just say you're getting a 1.5x every time, which is lower, but you never lose. And that just keeps compounding. You're going to come out far ahead of the guy who's shooting for 2x, but has a 0 mixed in every once in a while, right?
And that's another mistake that sometimes I hear LPs make is that, hey, your return projections don't meet my criteria. And it's like, well, hey, let me just pull up the spreadsheet here and we can change a couple inputs and we'll get you exactly what you're looking for. So it really comes down to financial engineering, I think was the term you used earlier on. And this next question may fit in kind of to this topic on debt, but right now we're in a market where transactions are sort of stalled out. There's not a lot of listings, not a lot of transaction volume. What do you think is going to spur transactions to get going again? And if transactions do get going again, are you going to kind of back off and sit back on the sidelines and kind of observe for a while? Or what's your take?
That's one thing I've been wrong on. I thought transactions would pick up by the second half of 2024, and here we are, not far from the second half of 2025, and very little is happening. I think what we got wrong is we underestimated the willingness of banks and lenders to, let's call it, extend and pretend, or play along. I think part of it is they learned from 2008 that, hey, we don't just want to foreclose on everything all at once, because that actually, that creates great opportunity for guys like us who are buying. It's not good for the lenders or the industry as a whole. That has delayed things. My best guess is that what will spur transaction volume is a couple of different things. One, if interest rates, again, let's just use the 10-year as a proxy, but let's just say the 10-year treasury gets down below 4% and kind of holds there. That seems to be, from our being in the market the last couple of years, that seems to be kind of like the psychological threshold where, like, once that 10-year gets below 4, for some reason, everyone's like, game on, right? And sellers start coming to this, and it does. I mean, deals do underwrite better the lower that gets. Like, I mean, there's properties we've looked at that, if the 10 years at 4.5, it doesn't work. But if it's at 3.9, now this gets more interesting. So number one, interest rates coming down could spur transaction volume. Two, if the banks stop modifying and extending, there's a lot of deals that are on life support, and it's like, okay, but that's great, Andrew. We thought that was going to happen a year ago. What would cause the banks to stop playing along? The best answer I can come up with that is, you got to remember, no offense to my lender friends out there, but your bank and your lender, they are looking out for nothing other than their own balance sheet. And if they look at your deal and say, hey, if we foreclose, we're going to lose $3 million today, they're probably going to work with you. The minute that the market shifts and lenders feel like that they can make themselves whole by saying no more extension, either you find a way to pay this off, or we're foreclosing, or we're taking it back, the minute that the lenders en masse feel like the market is a position where them being aggressive will make them whole, then I think that's when extend and pretend will end. Meaning they're like, hey, we got to protect our balance sheet. We got to protect our investors. We got to protect our ability to lend. So if I extend this today, I don't have to take the hit. If I foreclose, I do. So, hey, if I wait 6 months and all of a sudden pricing goes up a little and the market's liquid, and now I can foreclose on this guy or force him to sell, they're going to do it. They don't care about the sponsor's equity. They don't care about the LP's equity. That's not their job. Their job is to protect their own balance sheet. So when the market gets to a position where lenders can be made whole by getting aggressive, I think that's when you're going to see a lot of this stuff get pushed through. And then also, just keep in mind, commercial real estate is a slow moving machine. The great financial crisis started in 2007. We bought some of our best deals in 2012, 13, and 14. Like, it takes that long for it to work through. So, am I going to be sitting on the sidelines? Absolutely not. I really believe and hope that is very probable the next 2 years are going to be opportunities to buy great properties in great locations at a lower basis that otherwise wouldn't have traded. People are, again, being forced to sell great assets. Could pricing come down 5% more or 10% more from where we are today? Yes, it could. But again, if you're looking at the proper long-term horizon, 5, 7, 10 years, that's not going to matter. Then also, again, if you're buying it right, you're financing it properly, you have cash flow, you got the right basis. Again, you're planning on waiting through that. And then the second thing is, real estate's not the stock market. You can't sit on cash and be like, ready, buy, done. And then, okay, I have my portfolio. Deals come when they come, and if you're not ready, they're gone. Can't do it instantly. It takes time. You have to build a portfolio over time. So you can never time the exact bottom. In general, you want to accumulate near the bottom and maybe distribute near the top. But so all that to say, we are, carefully trying to acquire as much as we can. With all that said, the last 2 deals we bought, those were 2 out of just over 1,000 that we looked at. So it is not easy to do right now. But once we find those, we absolutely want to grab them.
I heard patience, long-term horizon, multiple business plans. This is not a get-rich-quick scheme. So this has been an awesome interview, Andrew. Appreciate you coming on today. Learned a lot. And where can our listeners find out more about you if they want to find you?
I'm not a social media guy except LinkedIn, which is where we get to talk a little bit. That's the one spot that you're never going to see me dancing on TikTok. I have CRD, Caucasian Rhythm Deficiency, so it's really really bad if I try to do anything like that resembles dancing. So, but yes, LinkedIn, that is the one that I am active on. Ski season's finally wrapping up, so I'll be on there more now that the snow is melting. And if you comment on a post, that actually is me responding. It's not an assistant. I don't use ChatGPT to make posts, so that it's all real stuff. So please connect with me there. And then the second best is just our website, Vantage Point Acquisitions. It's vpacq.com. There's a couple of tabs on there for different ways to set up a phone call or connect that way. So
Great. Thanks again for coming on, Andrew. It's been great.
Yeah, it was great talking to you guys. Really enjoyed it.
Thank you, Andrew.
That wraps up today's conversation with Andrew Cushman. A big thanks to him for his insights on today's market, lessons learned, and advice for passive investors navigating a shifting landscape.
If you found this episode helpful, be sure to like, subscribe, and leave a comment. For more tools and education to support your investing journey, visit www.PassivePockets.com and check out our 7-day free trial. Thanks for tuning in, and as always, happy investing.